Okay, business owners, I want to be really honest with you. In spite of some of the social media spin regarding the 2025 tax law, it really didn't reward business owners the way that I feel like people are portraying. It kind of can come off like we got all of these shiny new deductions and tax breaks to save money. But instead, what it really did a lot of was just extend expiration dates on legislation that was already in place. And the reality is, it put more legislation and responsibility for documentation on business owners than ever before. So these are going to be things you're going to need to document in order to stay in compliance. And you're going to have to make sure that your paperwork is really on par so that you don't end up getting hemmed up by the IRS. So the goal in this episode is to get more of a deeper understanding around what is available to help you avoid tripping over some of the bad tax advice that's online. Because some of what is being shared right now sounds really great, but only if you properly utilize or implement those that legislation. One of the reasons that I wanted to do this series in general was just because there is a lot of bad tax advice online right now. And sometimes we get it wrong by not intentionally giving bad advice, but the fact that the advice is so incomplete or that it's oversimplified or taken out of context, it can cause you to track all these headlines that don't tell you who the rule actually applies to or when you should implement it so that you can get the best out of your situation. They often don't tell you what hasn't actually changed, but they try to package everything as though it's this new great tax law or this new great thing, when in reality it's old law that's just been maybe updated for what they call like cost of living or inflationary adjustments, things like that. Or sometimes they're just tax law that is already in place, but they're expanding the deadline. So some legislation might expire over time, but they might expand that so that it doesn't expire in the year that it was originally intended to expire or something like that. But it's not really new tax law, and some of it doesn't help out as much as what I think that some content creators try to portray. So in an effort to help you guys be able to be in compliance, right, while still taking advantage of some of this really attractive tax law, we want to make sure that we're going through some of the rules. And again, not trying to make somebody feel like, you got to be a tax expert in order to be able to take advantage of the tax law. That's not always true. So we just want to at least give you an idea of like how some of these different laws or some of the provisions can actually be helpful to you, and some of the questions that you're going to want to ask your tax advisor so that you can make sure that you're getting the most out of your out of whatever legislation is available to you, and really taking advantage of those laws so that you pay less taxes and do it legally, right? Okay. So one, I want to make sure you guys know I'm not here to scare anybody with tales of the IRS boogeyman. Okay. I just want to make sure that you guys implement this stuff or ask the right questions so that it can be implemented in a way that won't actually hurt you or give you the opposite effect of what you're looking for. So to recap on some of the legislation that we talked about previously, I want to remind you that some of the new areas of compliance that you want to be careful about, they deal with legislation around no taxes on tips and no taxes on overtime. So this is one of those laws that it really was put in place to help individual taxpayers, not really business owners. And it actually creates an environment where we have additional compliance requirements and reporting requirements for small businesses than more than we had before. So business owners, by now, you guys really should have already issued your W-2s and your 1099s for the end of the year. Since this is the first year that this particular law has been put in place regarding your W-2 employees, one of the things to know is that because of the shutdown that happened last year and some other obstacles that were put in the way, the IRS didn't get a chance to implement new W-2 forms. So what that means is that there's some adjustments that we have to make in order to make sure that the employees get the information that they need so that they can report the portion of their portion of their income that's not going to be taxable. So tips are going to continue to be put into box 7 on the W-2. So make sure you double check that box. And if your employees have qualified tips, make sure that there is a number in there. Now for overtime, qualified overtime that is exempt from taxes, that's going to be a little bit different. That's actually going to go into box 14 as a temporary provision. So be aware that that's really for this year. It might change next year. And so you're going to want to make sure that the qualified overtime goes in that box 14 on the W-2s, and you want to just double check your W-2s to make sure that that has been disclosed properly. Now, let's say if you've already given out your W-2s this year and you go to double check them and it's not the way that it's supposed to be, you don't have the numbers disclosed in the proper places, then that's okay. The IRS also has a provision that says that you can issue your employees a separate report, and that separate report can have on it the information that they're going to need for preparing their own taxes. Okay. Now, something that I want to make sure I make clear is that you may have payroll software, or you may have a payroll firm that is, helping you with preparing your payroll taxes, your W-2s and stuff like that. But the bigger issue is that I want you guys to really take to heart is that at the end of the day, the business owner is still responsible for making sure that that information is disclosed properly. So you cannot abdicate your responsibility off to the payroll software or the payroll service. At the end of the day, if something goes wrong, the IRS is looking at you as the business owner to make sure that that information is properly disclosed. So just make sure that you're, handling that part correctly. Make sure you're disclosing it properly, because it is a requirement that if you have employees that have qualified overtime or qualified tips, that you disclose that information. So make sure that you're aware, make sure to check the proper boxes. And if it's not on the boxes, make sure to get those supplemental statements out to your employees so they have the information that they need. Okay, next, let's talk about QBI, or qualified business income deduction. This is a 20% pass-through deduction, and it's been in place since 2017. It's not anything new. One of the things to note is that they did expand in the 2025 law the percentage increase, a percent increase on for those who have a limitation, how much income you can make before you hit the limitation. And I'll go a little bit more into like that limitation thing a little bit more later in this particular segment. So generally the way that it works is that you would take your total income, you minus your total business income, you minus your total business expenses, and then you end up, of course, with your profits. And in that profits, you get to take about 20% of pass-through of those pass-through profits and make them non-deductible. You get basically a deduction on them, right? And this can be limited based on, or it might have to have an adjustment based on the amount of fixed assets that your company holds, or the amount of W-2, total W-2 payroll that was issued out for the year. So just be aware that that could be a slight limitation, but in general, we're talking about 20%. So an example would be if your company had profits of $50,000, then you would be looking at around about a $10,000 deduction that would be available for you. So then you would take 50 minus 10, that would leave you with $40,000 of taxable income in that scenario. Now, something to note, if you are a specified service, trade, or business, an SSTB, you may have an additional restriction on whether you can take this deduction. There are some minor increases, like I said, on the income threshold that you can have and still take the deduction. But these kinds of businesses, with these kinds of businesses, you'll want to make sure you check to see if your company fits that description and is subject to the limitation, so that you can at least be aware that you might not get that full deduction. In general, an SSTB is a business that the limitation, on the SSTB income is going to be right around $197,300 for a single person and $247,300 for a married couple. And so that basically means if your income gets to that level, then the amount of QBI that you can take will start to be phased out. Now, that deduction is totally phased out for single filers who make over $394,600 or a married couple that makes over $494,600,000. So it's basically these very high income earners that have a business that unfortunately may see some decline in the amount of QBI that they're allowed to take in a given year. And if you're wondering, well, what kind of businesses are these? These would be like legal professionals, healthcare professionals, consultants, that those industries would possibly have a limitation. So make sure that you find out whether or not your company is considered an SSTB if you're in those income levels. So that way, when you're kind of estimating how much you might owe in taxes at the end of any given year, you are taking into account that your QBI might be limited. So another item that is on my this is not new list, but it is something that could be helpful to your business, is the retirement plan setup and retirement plan funding credits. These credits were originally expanded under the Secure Act of 2.0, which was back in 2022. They are still available, which is, of course, a good thing, especially if you're trying to give additional benefits to your employees because you're trying to help, increase retention, right? Or if you and your family are the only employees, but you want to start setting up a retirement plan for yourself and your family members that work in your business, right? One thing to be aware of is that unlike a personal tax credit, these tax credits are not automatic. So you got to make sure that your tax preparer, or if you're doing your own taxes, that you take this into account to make sure that you include it in the preparation of your tax returns and that you don't miss out on this tax credit. These credits do not replace a need for cash. So if your company doesn't quite make it when it comes to having the necessary cash flow to consistently contribute, then this might not necessarily be the best option for you, because you need to make sure that you're going to be able to fund those retirement accounts. They do require correct plan design, consistent funding, and ongoing compliance. But generally speaking, most people will go to a manager for this kind of stuff, like a retirement plan manager, and that retirement plan manager will know what plans qualify. So make sure you're asking those questions like, hey, would this qualify for the setup credit, or would this qualify for the funding credit, so that I can make sure I'm taking full advantage of that. And be aware that whether you do a withholding only plan, which is where basically, the employees can choose to withhold, but you're not giving a match, or if you plan to do a matching program where you're giving some kind of match, a 2, 3, 4% match, whatever, it is that you decide, make sure that the credit is applicable for that type of plan. So with the withholding only plans, there's some credits that are not eligible for if you have that kind of plan. So just be aware that that can be a problem if you're not just being careful and planning that part out properly. Okay. Next up is going to be our business EV or electric vehicle credits. So business EV credits sometimes, unfortunately, can be overly simplified. They can also sometimes, people will misinterpret the EV credits. And so you want to make sure that if you want to take advantage of those credits, that you are specific about looking at the rules around what you can and cannot do and still qualify for that credit. So one of the issues is that it does depend on the kind of vehicle, and even the weight of the vehicle can determine whether or not you get to take that business EV credit. So the details are really, really important because the rules to qualify for these credits can be pretty strict. A lot of service-based industry clients are not going to be, a lot of service-based industry business owners are not going to qualify for this particular credit, so it won't necessarily be a win for them. But the biggest issue around this tax credit and where people get it snatched from underneath them is when they have poor documentation, and it will cause them to lose their credit. So buying a vehicle so that you can take that tax credit without planning properly, making sure that you're getting the right kind of vehicle, when it qualifies and all that kind of business, those things, can almost ensure that you miss out on this deduction strictly because you didn't know. So make sure your ducks are in a row and that you make sure that you have taken all the different rules into account. Like with any information that I give here, the details on how to qualify on what the rules actually say can easily be found on the IRS website for absolutely free at irs.gov. That's irs.gov, short for government. You can also get additional help navigating all of this stuff by booking a meet and greet with us to discuss what strategies would actually work best for you and for your specific situation. So next up, I want to talk about Section 179 deductions and bonus depreciation. So Section 179 can be a really powerful tool, but you want to make sure that you actually qualify to take those deductions or the 179 implementation. I can't tell you how many times business owners will bank on getting some kind of theoretical benefit from one of these provisions, only to find out that they didn't even qualify to take the deduction. So let's break it down a little bit, and we're going to start with our 179 deduction. 179 deduction, in short, allows businesses to fully expense certain assets that normally would be required to be depreciated over time. So first and foremost, you have to have purchased capital assets, or which are also sometimes called fixed assets, to even utilize this provision. Some examples of fixed assets would be things like computers and office equipment and large equipment that you use if in your business. Furniture, office furniture would be one of those. So you might ask, well, what does depreciation mean? So since these would be assets that normally would have been depreciated, right? So you can kind of think of depreciation like a bucket. So you have a bucket of deductions, and each year you get to take a portion of money out of that bucket and you get to deduct it. Okay, so an example might be you might have a laptop, right? So laptop would be what they call 5-year asset, and you would have this, let's say you spent $2,000. So you would put $2,000 in the bucket, and each year you would take 1/5 of that on average out, and you would get to utilize it as a deduction. So on average, it would be right around $400 per year. Now, mind you, That's not the technical way to calculate that. I'm just trying to give you an example to help you understand the concept so that you'll, understand kind of like how it actually works, right? So what's 179 deduction allows you to do is in that very first year, instead of having to apply that averaging and taking a little bit at a time, it allows you to take the full amount of the deduction, the whole $2,000 in the year that you make the purchase. Now, that can be really helpful. However, there are additional rules around being able to utilize a 179 deduction. So some of those rules would include that your company actually has to be profitable. You cannot take a 179 deduction if your company is already in a loss position or if it will create a loss for you. So you have to be profitable to be able to take that 179 deduction. So that's a number one around that. Assets also have to have a legitimate business use. You can't just go around buying stuff and thinking, oh, I'm just going to deduct it as a 179. It actually has to have a legitimate business use. And the asset, any asset that you purchase that maybe has a business use, but it's a partial business use and then a partial personal use, unfortunately, sometimes that can cause you to actually be totally ineligible for the 179 deduction if it is a partial business use. There is also a limitation on the maximum amount of assets that you can purchase, but most people don't have to normally worry about that, or most small businesses don't have to worry about that, because the maximum number of assets that you can purchase and the maximum deduction that you can actually recognize are in the $4 to $6 million range, and that would be $4 to $6 million of purchases of assets that you would have to have in order to exceed those limitations. So generally speaking, in addition, the state will also authorize you to recognize the 179 deduction. And this can be kind of important because some of the provisions, the depreciation provisions that are eligible or available to you at the federal level, the state has decided not to recognize that deduction or that provision. And so it's important to know which ones the state does not recognize, because again, it means that your deductions for the state will be lower, meaning your taxes will be higher than they would be for the federal side of things. Okay, so one thing to note, buying something just to get a write-off is not a very good strategy, because at the end of the day, the amount of money you're going to save in taxes is not going to be dollar for dollar your purchase, right? So you spend a $2,000, the amount of taxes you save might be closer to maybe $500. Well, in that scenario, that means that you're still out of pocket $1,500. So your cash is still lower by the amount of money you spent minus the savings in your actual taxes that you're going to get, like how much in taxes you actually have to pay out. So just be mindful that when you're looking at these strategies, you really want it to be a situation where you're considering deducting things that you already need, and you're trying to make a decision on when to deduct them as far as like what's going to be best for your situation. Okay. Now, bonus depreciation, it is different. It's not the same as the 179 deduction, although it does function similarly. So for 2025, the bonus depreciation max is going to be 40% of whatever the amount of assets that you have purchased. So one of the great things about that bonus depreciation is that bonus depreciation does not require that you have a profit like it does for the 179 deduction. One of the downsides to bonus depreciation is that a lot of states will not recognize the bonus depreciation provision. They have not adopted it. And so you'll end up with two different taxable income amounts. one that's for your federal and one that's for your state when you implement the bonus depreciation. One of the things to take into account, like if you're looking at strategy, is to note that in 2026, the federal limitation on how much you can take in bonus depreciation has increased. It's gone up to 100%, effective January 1st, 2026. So again, so it kind of is going to function like 179 in that you're going to get a full deduction starting in 2026. However, because some of the states, or a lot of the states, most of the states have not adopted the bonus depreciation provision, just note that your taxable income for the state and your taxable income for the Fed are going to be different. And so you're going to have to make sure you're accounting for that when you're thinking about how much in taxes overall that you're going to have to pay. There are some states that are phasing in or that have set a specific date that they are going to implement bonus depreciation. And those states would include Illinois, Massachusetts, New Jersey, California, and Michigan. So if you are in one of those states, you might want to just double check the law around bonus depreciation, and you might be in a position where you can get an additional tax benefit if you did purchase capital assets in 2026, or if you had purchased capital assets if you had purchased capital assets in 2026. But just remember that for 2025, the max bonus depreciation is going to stop at 40%. And so, like in the example that we were talking about earlier, if you had bought a $2,000 laptop, and let's say your business already has a loss, so you can't take the 179 deduction, but you would like to get as much of a deduction as humanly possible, right? So in this case, if you take the 40%, that means in year one, you're going to get a $800 deduction. And then that will be followed by the remaining $1,200 being deducted over 5 years. So that's how that would work. An important note is that in the past, the bonus depreciation was a temporary provision. Well, with the 2025 tax legislation, it did expand that. So not only is it going to expand it so that it goes back up to 100% where it was a few years ago, but in addition to that, has also become a permanent provision so that there will no longer be a phase out on that provision. So like in the past, it would be at 100% and then each year it would go down. That's not going to happen this particular time. So unless Congress actively changes the provision, it will actually not be reduced each year over the next few years. One more thing to just kind of as to summarize and to recap, I just want to make sure that you guys remember that these provisions are only apply when you purchase capital assets. If you haven't purchased any capital assets, then none of this stuff even applies to you. And so just be mindful that we're talking about things like, again, laptops, office furniture, office equipment, even carpet if you have a rental property, or if you put carpet in your office, your business office, things like that. That's when it would count. It also actually counts for business build out. If you have a commercial building, commercial location, you would be able to use some of these provisions. So next up, I want to talk about business interest expense limitation. So I've seen a couple times where there's this trend where they talk about basically using OPM, other people's money, to build your business and to even live off of, and to do it in a strategic way. While the supporters of this strategy, and I will have to admit, I am not necessarily a big fan, while the supporters of this strategy will try to make it sound simple, it is anything but simple. Okay. If this is improperly implemented, or if you recklessly just dive into trying to make it work without wisdom and structure in a system, you could actually end up getting the opposite result and actually triggering more taxes not having less. One way that this can happen is based on the business interest expense limitation laws. So this is section 163J for anybody who really wants to know, but the point is that it really affects those who have highly leveraged their companies or basically have a lot of debt or business debt, and those who are maybe operating at what we call low margins, low income, or maybe even operating at a loss. If a business doesn't have sufficient taxable income as defined by this regulation, some of the interest expense may not be deductible in the year that it was paid, essentially making more of your income taxable, which means that you'll end up with higher taxes. Evaluating the possibility of this is especially important for businesses that borrow aggressively. Another way that living off of loans, whether it's your business living off of it or you're personally, that it can bite into your company and give you more is when your company is issuing distributions to your owners, and those distributions to owners are in excess of the actual income that the company is making. So just to clarify, generally speaking, a business should really only be sending out distributions to the owners based on actual profits. Okay. So if you have profits, then you issue distributions. If you don't have profits, then you technically wouldn't give out distributions. However, sometimes what ends up happening is the owners end up giving out distributions to themselves based on the money that is actually in the bank, not necessarily the profits. And this can happen especially when there is a lot of debt that the company is engaged in. Okay, so business owners that take distributions, this could result in the owner essentially borrowing from the company, is the way that this can look to the IRS. These kinds of loans and borrowing from the company can end up requiring interest income to be recognized by the company and taxed, even if the owner is not paying the funds back and not paying back the money based on an interest-bearing loan. There actually could be a requirement to do what they call impute interest because of the way that the money is functioning, and because the company is essentially playing the middleman as for debt, because it doesn't have actually enough profits to distribute to the owner, but it has cash because of the debt that it has on its accounts. So these types of concepts can be really complicated, and a lot of times they can catch business owners off guard and totally unaware. So if your company does have a significant amount of debt, or if you are an aggressive borrower when it comes to your business, it is really important that you seek the advice of your tax advisor to see which laws might apply to you, to see if there's limitations in the interest that you can deduct, or to see if there are additional imputing of interest that might be required just because of how the company is structured and whether or not they actually have profits that they can issue the distributions from, or if they're actually stuck issuing it from just cash available, which sometimes can include debt that the company has. So very last thing that I wanted to talk about today is around the possibility of being audited and the IRS coming, quote unquote, coming after you, as people would say. Again, I'm not going to get into fear mongering or trying to tell people about how, the IRS boogeyman is going to come get you. Because the truth is, if we're being honest, is that the IRS the likelihood of the IRS knocking on your door and auditing you is less than 1/4 of 1% to maybe half of 1%. So, on average, you know, that's about maybe 1 out of every 250 to 400 taxpayers that actually gets audited. When you average it out, it actually ends up being less than 1/3 of 1% of taxpayers that get audited. The most common kind of audit is what we call a paper audit, or is also called a correspondence audit. And these kinds of audits make up somewhere between 75 to 85% of all audits that occur. And basically, what these are love letters from the IRS strongly requesting that you provide additional proof or substantiation for something that you have claimed on your taxes. On average, about 500,000 or so correspondence audits are issued every year, a little bit more than 500,000. But the thing to remember is that there are so many taxpayers. As we said earlier, the effect of this is really 1/3 of 1% of all taxpayers. But here's the other issue. Even though 1/3 of 1% is a very, very tiny number, it only feels tiny and small if you're not in the 1/3 of 1%. If you're in the 1/3 of 1%, that number feels huge. So bottom line is, we want to make sure that your business has the least number of possible issues that can come up, and that the business owners don't suffer from IRS induced anxiety around your taxes, right? And one of the best ways to do this is by keeping clean books, properly documenting your business activities, and putting in place systems that help you to steward your business and have good advisors around you that inform you, so that whatever it is that you need in order to make the best of the tax law for your company, you can make really informed decisions around those provisions. That way, if the IRS comes knocking at your door and asking you for additional information or for substantiation, you can simply give them their copies of your records and send them on their merry way, and knowing that the deductions that you have are airtight and defendable. You want to be able to rest well, knowing that you are prepared for any kind of scrutiny that might come your way, because you're dealing above board. If you are looking for affordable accounting software to help you with this tracking and getting your stuff organized, our vendor of choice, the one that we recommend the most, is going to be Xero Accounting Software. That's XERO. I'll say that again, XERO, Xero Accounting Software. You can check out their website at xero.com. And currently they have a special. So yeah, definitely check them out. It's $3.75 a month for the next 6 months, guys. Super, super inexpensive. And that price is super affordable. And even when it goes to their regular price after the promotion is over, it's only $25 a month for their baseline tier for the software. So that would be usually our first choice when it comes to subscribing to accounting software. Now, just be mindful. Every software is not for everybody. It doesn't mean that it's necessarily the best software for your circumstances. If you have something that's specialized, or if you have any special circumstances around your business. So it doesn't hurt to, get a little advice around that. So make sure that you're getting the option that's going to be the best fit for you personally, and for the level and status of your business at this point in time. You want to make sure that you're, taking all those things into account. But, we definitely highly recommend that you get some kind of accounting software that works well for you so that you can, one, quickly, um, accurately, and systematically get this information into a organized and usable format that can help you to be able to manage that part of your business. Because for those of us who are entrepreneurs, we all know running your business is not just delivering whatever it is that you do for your clients. That's like probably the part that inspired you to create a business. That's the part that you probably love the most. But there are all these other background pieces that also have to be managed and taken care of, and that you have to be informed about in order to be able to effectively and efficiently run your business, but also to prepare your business to eventually be able to grow. And if you're wanting to be able to scale your business. Okay. So my role as a CPA isn't to give you a bunch of hype or fluff around tax law trends. Our goal is really to help you to see how beneficial some of them are and how they can help you. It's to help business owners like you understand what applies to you and to consider all of the different aspects of the provision that may or may not be in your best interest so that you can evaluate where the real benefits and real risks are. If something sounds too good, guys, a lot of times that means that it is. So especially when it comes to tax law, make sure you're doing your research and knowing more about how these things work. Like, again, not trying to make you into a tax professional, but this stuff really does apply to your business. And at the end of the day, you guys have to make the bottom line decisions around what's going to be best for you and for your business, for your staff, and for your clients, right? So if you want to talk through any of this stuff and see how maybe the tax laws apply to your business and to your specific situation, schedule a meet and greet using the link below in our description or in the bio. And let us sit down and talk about like what would be beneficial for you, what might not. And then we can make sure that you are getting the most out of whatever tax legislation is available to you. And as always, we ask that you please make sure you comment, like, and subscribe so that you can get notifications when we are doing lives or when we are dropping new content that could be really helpful to you. I pray that this information blesses you and blesses your business, and that it helps you to make more informed and wise decisions that help your business to grow and thrive. I pray that your business will be incredibly blessed this year to be a blessing, and that we wish you the most best year to date as we get through this 2026 tax filing season to get the 2025 tax returns done. So again, thank you guys for coming on. Thank you guys for checking us out. And we look forward to seeing you at the next live. Take care now. Bye.